Hi, the title of my paper is Why Was the EESA approved so quickly? For those who don't know, the EESA stands for the Emergency Economic Stabilization Act of 2008. It is a form of fiscal policy that is usually used as an aid during recessions. For me, is an important topic because as U.S. citizens, we should all have a better understanding of what actions were taken in order to improve our economy after the financial crisis of 2008. A question I always ask myself is why did the Congress approve this so quickly, knowing very well it would increase the economic inequality gap in the U.S. by a lot? Many economists believe that this was absolutely necessary in order to improve not only the U.S. economy, but the whole world's economy. And that may be true, but my argument is that the funds should have been taken out of the higher income families instead of the lower income families, thereby preventing such a large income inequality gap in the U.S. After all, they were the ones who created the crisis in the first place. So I will support my argument by highlighting the weaknesses of the EESA and introducing you to alternative policies that were also proposed and Congress denied them. These policies would have not only helped the U.S. economy, but they would have also benefited the U.S. citizens as well. I will show you all this in my PowerPoint presentation.
Okay, so as I said before, my argument is if the EESA was truly necessary to help the economy, then the funds should have been taken out of the higher income families' pockets instead of the working class, thereby preventing an even larger income inequality gap. After all, the people in that very same income bracket were the ones who caused the crisis in the first place. For those who don't know, the global financial crisis of 2008 was a liquidity crisis, which means a lack of cash flows. It started out as a subprime mortgage crisis, which then affected the financial institutions and later on the stock markets. Once the financial institutions and stock market began plummeting, it was clear that this was no longer an issue solely in the U.S. Soon other developed countries, especially in Europe, began to fear global economic collapse. Due to this global scare, many bills were proposed to the U.S. Congress in order to prevent another recession. The Emergency Economic Stabilization Act of 2008 was proposed in September 2008 by former U.S. Secretary Henry Paulson. He was also the former CEO of Goldman Sachs. It was an intentionally short 3-page proposal in hopes of a fast approval. The proposal basically wanted the federal government to buy $700 billion worth of illiquid mortgage-backed securities. And the purpose of this mortgage-backed securities were to increase the liquidity of the secondary mortgage markets and reduce potential losses encountered by financial institutions owning the securities. Mind you, the illiquid assets was the very same cause of the crisis in the first place. So the bill was approved by Congress on October 3rd, 2008, and it became a law with some new additions. First, the allowance of the Federal Reserve to pay high interest rates on bank deposits held for reserve requirements. Second, the Troubled Assets Relief Program, also known as TARP. The purpose of TARP was to purchase troubled assets and equity from financial institutions to strengthen its financial sector. The third being the Capital Purchase Plan, the fourth being the FDIC insurance, the fifth being budget-related provisions, and the sixth being tax provisions. The Emergency Economic Stabilization Act of 2008 claims to have many beneficial factors towards not only the U.S. economy, but the global economy as well. One benefit is that it stabilized the economy by pumping the lenders full of confidence to be able to lend to other banks. Another is the domino effect. For instance, just as other developed countries feared a global economic collapse if America's banks were failing, the fact that America's banks are now back on their feet and can lend to other countries as well keeps the economy moving forward. Another advantage is liquidity improvement, which helps all of its bank members, which include both individuals and businesses. Another one is it prevented another recession. And the last one being the unemployment rate. TARP saved 8.5 million American jobs according to USnews.com. So to say the least, the two biggest gains from the EESA was the prevention of another recession and keeping the unemployment rate from rising even higher. Now for the cons. The biggest one being the dramatic increase in the income inequality gap. As we have seen in a previous lecture video, economist Pavlina Tishaneva's distribution of the average income growth during expansions chart. Before the global financial crisis, the bottom 90% was at 0% and the top 10 was at 100%. After the global financial crisis, the bottom 90% went down to negative 20%, as the top 10 increased nearly 120%. The wealth gap grew because the CEOs of the banks that were bailed out used a ridiculous amount of money for their own personal bonuses. According to the New York Times, President Obama called financial institutions shameful for giving themselves nearly $20 billion in bonuses as the economy was faltering and the government was spending billions to bail out the financial institutions. Another con being moral hazard issues, which is too big to fail. These banks now feel that they are too big to fail thanks to the bailout. Therefore, the investors have no problem engaging in risky behavior because they suffer no consequences. In other words, they get to enjoy their returns on investments when banks are profitable, and once the banks fail, they know the government will bail them out, so again, they receive their profits. It's a win-win situation. Another con being the financial burden fell on American taxpayers from the middle and lower class. The cost was about $5,000 per U.S. worker. Many perceive this as an unfair cause because taxpayers do not reap the benefits of these private firms. Therefore, they shouldn't be responsible for paying for their failures. Another con is that the EESA law established TARP, which led to the creation of the CPP. The capital purchase plan intended to stimulate the economy by providing new capital to banks. This allowed the government to directly purchase equity in troubled banks, redirecting it away from mortgage-related assets, which were the original purpose of the EESA in the first place. In other words, the EESA was created to provide mortgage-backed securities. Meanwhile, it actually provided little mortgage relief and huge bank bailouts. One of the biggest cons was that the bailout money was supposed to be used for the banks to give out loans to individuals and small business owners in hopes of ending the lending freeze. But in reality, most of the money was kept by these financial institutions in order to increase their liquidity. As you may know, politics always play a major role in influencing macroeconomic policies. According to a study done by academic economists Rand Dushin and Denis Sosura, political connections and government investments are indeed related. The U.S. banks that spent more on lobbying received more in bailouts. Banks whose executives served on the Federal Reserve boards were 31% more likely to get funded. Banks with connections to a finance committee member were 26% more likely to receive financial assistance. A prime example is Barney Frank. He was the chairman of the House of Financial Services Committee from 2007 to 2011, which took place during the global financial crisis of 2008. He made sure his small home state struggling bank, One United Bank in Boston, received $12 million in funding, although according to TARP, only healthy banks qualify for financial assistance. This clearly demonstrates the power political influence holds on the formation of the EESA of 2008 and other fiscal policies. As for policy outcomes, the EESA spent $431 billion out of the original $700 billion. Taxpayers lost only $32 billion as opposed to the estimated $63 billion. As you can see, I made a pie chart. $313 billion, which was 52%, went to financial institutions. $205 billion, which was 34%, went to preferred stock from 707 financial institutions. $80 billion, which was 13%, went to auto industry. Meanwhile, only $5 billion, which is 1%, went to the housing programs. And according to TARP's housing program's budget, it had $40 billion, yet less than $5 billion had actually been used. So here you go, the housing versus the financial institutions. Here are the top 5 bailouts in 2008. Number 1 being Wells Fargo, number 2 being State Street Corp, number 3 being Bank of America, and number 4 being JP Morgan Chase & Co., and number 5 being Citigroup. All of them had between $2 billion to $25 billion in bailouts. Meanwhile, there have been 2.3 million houses foreclosed in 2008, and the foreclosure has slightly gotten better. It's still in the millions since judging from 2014. Now, not many people are aware of the alternative ways of fiscal spending that were proposed to and denied by Congress. First, there was mortgage assistance programs. For instance, Hillary Clinton suggested a revised homeowners loan corporation, which was used after the Great Depression. Mortgage assistance proposals were made to increase the value of the asset while limiting foreclosures. another one being bank recapitalization, which was to provide cash in exchange for preferred shares and suspending all dividend payments. The third one being asset liquidity, which is having the government back up troubled assets in order to encourage private investors to purchase them. Another one being financial market reforms, which were also suggested to assist banks. The last one being monetary concessions reform, which required the nationalization of most private industries, but was quickly dismissed by bureaucrats and lobbyists. I wonder why. As for my argument in which the funds should have been taken out of the higher income families' pockets instead of the working class, thereby preventing an even larger income inequality gap, is largely based on one bill proposed by Senator Bernie Sanders in 2008, which was a 5-year 10% surtax on families with incomes of more than $1 million a year and individuals earning over $500,000 to raise $300 billion to help bankroll the bailout. This bill ensured that the bottom 99% did not have to pay for the crisis that the top 1% created themselves out of pure greed. Out of all the proposals made, this was the only one that addressed the increasing income inequality gap and found a way to reduce it. Sanders also pointed out that the EESA didn't acknowledge most of the major economic crises America faces, which are growing unemployment, low wages, the need to create decent paying jobs, rebuilding our infrastructure, moving us to energy efficient and stable, sustainable energy. Unfortunately, his amendment was set aside by the rest of the Senate on a voice vote. Ultimately, the very same people who have caused the global financial crisis of 2008 were the ones who should have been accountable for it financially. Only in America is it just to have taxpayers who are losing their houses pay for the economic failures caused by the greed of the top 10%. Many alternative solutions were proposed to Congress, but only the EESA was approved. The EESA was successful in avoiding another major recession by saving America's largest banks, thereby stabilizing the economy. Furthermore, the financial institutions did not use most of the bailout money to diminish the lending freeze. Instead, they used it to increase their liquidity and for their own personal gains. Due to this issue, the EESA failed in every other aspect, including providing mortgage relief, minimizing troubled assets, minimizing the unemployment rate, shortening the income inequality gap, regulation in financial institution lending and spending. This clearly demonstrates that the bailout wasn't approved so quickly because of a lack of other solutions or it was better than doing nothing. It was approved simply because Congress felt more comfortable with taxpayers funding the bailout than the ones who actually caused it, the upper class. Thanks for watching.